Okay, so the cash flow statement. What does the cash flow statement tell us? Well, first of all, what is the cash flow statement? Well, it's basically a summary of cash coming in and cash going out. So it's similar in many respects to the income statement, but there are a few key differences which we'll talk about. So the cash flow statement tells us the ability of a business to pay its bills month by month. It shows the ups and downs of a farm's cash balance during the year and the ability of a farm to cash flow debt payments, which is really important. So to do a cash flow statement, you can take your income statement, which you see here in green, cash income, cost of goods sold, gross margin, fixed costs. You would not include depreciation in this case because that's not a cash expense. You would include things like loan payments in full because that is a cash expense. The result is your profit in cash. And then in red, this is like your checking account information. So we have what you started the month with in cash, what the change in cash was, and then that is your ending cash. And the ending cash for 1 month becomes the starting cash for the next. And so you would have January, February, March, you'd go across 12 months. So let's put some numbers to this. So for Chris's greenhouse, for January, let's say he sold some CSA shares. So we had $1,000 cash income. Cost of goods sold was zero because he hadn't done anything yet. Everything's frozen. So gross margin will be $1,000. Fixed costs, let's say he had a loan payment and he had to pay his insurance bill at the beginning of the year. So let's call that $600. Profit would be 400. 1,000 minus 600 is 400. So if he started the cash balance, the month with $10,000 in cash, add 400 to it. So he has 10,400 ending cash at the end of January. That becomes the start of the next month. And we go forward. So let's look at another example here. So this is if you would blow it up across 12 months. And we have those cash sales again. So, I mean, we have these numbers again. So let's look at this greenhouse example. So we have, in this case, revenue that starts in June, picks up in July, August, September, and then in October. So we have $4,000 total for the year. And you can see that's the total income. Then we have cost of goods sold. And note some key things here. One is that cost of goods sold starts before the revenue starts because you got to plant the crops before you can sell them, right? So in this case, in April, we had $600 in expenses, but no revenue yet. So that gave us a gross margin of minus 600. And then we had some fixed costs. We had some office expenses. So that made it even more negative. We have minus 700. So in this case, you can see we have our starting cash, our change. We carry forward. We started off the month with $2,900. Subtract 700, which is our cash flow for the month was negative 700. That leaves us with $2,200 for the month. That becomes the start of May. May was another negative month. And then we start to earn some cash back in June. So even though, in June, we start the month with $1,750. We add $125 because we have both revenue and expenses that month. So we get to $1,875. And then we go forward, as you can see. So even though this farm is profitable over the course of the year, it made $465 in profit on sales of $4,000. It could very easily, depending on what you started the year with, this farm could go negative if it didn't have the $3,000 in the bank already. So it's important to pencil this out for a year and make sure that your bank balance remains positive as you go month by month. And if you do run into a situation where your bank balance looks like it will be negative in a future month, that gives you the opportunity to play around with the numbers and say, well, could I bring in more revenue perhaps for this month? Could I defer some expenses? Could I start with more cash? Could I have a line of credit that I use? Do I need to transfer some cash from my personal savings into the company checking account? All those are different options to resolve a negative balance that you're forecasting. And so this can be a very useful exercise. And it's a lot easier to explore scenarios, if you will, on paper or in an Excel spreadsheet than it is to do it in real life, in real time. When your bank balance goes negative, you're overdrawn and you have to panic and scramble to pay bills. It's a lot better to forecast it ahead of time and plan for a positive cash balance throughout the year. So if in this case, we don't have line items for these expenses and for these revenues and expenses. We're just looking at some very compressed categories. So, but if we blow this up across 12 months and for our full scheduled chart of accounts, it would look like this. We'd have sales, and then we'd have income in various categories, gross margin, we'd have loan payments, that sort of thing. So how to build your own cash flow statement? Well, you can use a program like QuickBooks, or you can do it yourself in Excel or even on paper. As I mentioned in my personal example, growing up in a greenhouse family business, my grandfather did a cash flow budget every month that was just on graph paper. It was pre-computers when he was doing it. But he penciled out what he anticipated his revenues and what he anticipated his expenses to be every month to make sure that the business remained solvent through the course of the year. So you want to build a list of expense categories that make sense for your business. Separate variable and fixed expenses because they behave differently. And then make a 12-month cash flow budget to maintain a positive bank balance or solvency. And then look at cash in or deposits and cash out or withdrawals. And really, in many cases, it's all about the timing. For a lot of farms, the first half of the year is very expensive. And then most of the revenue comes in the second half of the year if you're a seasonal crop farmer. So the timing is very important to keep track of. And then you want to track other sources and uses like financing, capital spending. So if you're making a long-term investment like a tractor, you'll want to track your capital spending in terms of what you're going to be paying on either loan payments or if you're going to pay cash for it and what that's going to do to your bank balance if you write that big check. And here you can see a URL, farmcrediteast.com/farmstart. If you go there and go to resources, you can download a cash flow budget spreadsheet template that you can play around with, and it's got formulas in it pre-populated, so you can just add your expense line items to it and explore scenarios for your business. So getting back to this Chris's greenhouse example, so here we have, I've abbreviated the months just to make it fit on the screen. So we have March, April, May, and June. And we can see that March is a very expensive month for Chris because he's potting up all of his hanging baskets. So he's got production labor, pots, soil mix, seedlings, fertilizer. So his gross margin is negative $11.50. Then he's also got a loan payment of $50 that he has to make every month. So that is $50 to that fixed cost. So he's negative $1,200 for the month. So he started off the month with $3,000 minus $1,200 in cash, ends with $1,800. Then we fast forward to the next month. In this case, we have some revenue starting to come in. He's starting to sell some plants in April. But he still has some cost of goods sold. We have labor. We got to water all these plants every day. We have fertilizer costs that go into it. And then we have a loan payment and property taxes are due for the first quarter. So in this case, we have still a negative cash flow for the month. just slightly negative, but it's minus 50. So we end up the month with 1750. That carries forward to be the starting balance of the next month. And now we really start to generate some cash. So we have sales of $2,500, still some labor, and some expenses, that loan payment, but we're plus $2,100 plus for the month. So that brings our end of month cash balance to $3,850. That comes to the beginning of the next month, and then as you can see, we end June with just under $6,000. So that's just an example of how you can create a cash flow budget that makes sense for your business. And this is an extremely useful management document. So of all the statements, I would say the balance sheet is important for tracking your financial position. And it's very important for lending purpose, for credit purposes. The income statement is how you track your earnings, and it's very important for your tax filing. But the cash flow statement is really where you look at the money, the cash coming in and going out, and is extremely important for the short-term financial solvency of your business and making sure that you don't run out of money, essentially, in any given month. So it's one of the most useful financial statements from a management perspective. And if you blow it up across 12 months and across all the categories, you can see that it can get a little bit complicated. So this might look intimidating, but really all this is a blow up version of what we just looked at. So in this case, we have all 12 months in an annual category column. We have the revenue in various months. We have the expenses by line item. And then you can see we have overhead fixed expenses of various types. And then we have these other sources and uses of cash down at the low. So we have equipment purchases, equipment sales, funds borrowed, funds repaid, and then, the net cash from those other sources. And then here you can see the monthly cash flow. Some months it's positive, some months it's negative. But as a result, because of the way the business is budgeting, we end up the year with more than we started with, which is great. So how to use the cash flow statement? Well, you can experiment with different income and expense scenarios to see what it does to your cash flow and your bank balance. And it's important to keep it up to date with your actual revenue and expenses. It's not enough to just do a forward-looking cash flow statement that's a budget. You want to also keep it up to date with what you actually earned and what you actually spend, so that you have accurate information as the year goes on. Because if you just do a cash flow statement in January for the whole year, you will find, I'm pretty sure, that your actual numbers are going to diverge somewhat from what you predicted at the beginning of the year. The weather may or may not cooperate. Customers might not come the way you want. They might not spend money the way you anticipate. Expenses might change. So keep it up to date with your actual revenue and expenses. And you can use it to predict the business's ability to cash flow debt payments or a new capital purchase if you plan to buy a piece of equipment or invest in your business in some other way. So with that, we will conclude this section. Again, this has been Chris Laughton from Farm Credit East, and I thank you for your time and attention. And by the way, that's me on the left there in my family's greenhouse at age 5. So thanks a lot.
Right.
So how was that?
That was wonderful.
I tried to stick to my script as best I could.
Yeah, you did a really good job with